So, can you hear me? Can you see my presentation?
Yes, we can see.
Okay, thank you. So, today is data analysis. If you recall, I've told you at the beginning of the class that we have three major analyses in ICAN case study. We have the financial analysis, we have the business analysis, and we have the data analysis. I have walked you through the business analysis, same thing for the financial analysis, and I went in depth for financial analysis, stressing the fact that is one of the major areas of this paper. And today we're going to look at the data analysis. So after this time out, it means that we have an overview of the knowledge of courses that we need to succeed. So I never see any constraints before you value 99% of everything. Okay, so data analysis. Like I've told you that we have two major courses in the data analysis, which is SFM and PM. So I'm going to summarize it today. Okay, I'm going to walk you through and give you logics, behind solving some questions for you to derive your final answer. It's not all the topics in the SFM and it's not all the topics in PM, but we're going to look at the germane ones that sufficed, or that are shown, rather that are shown over the diet, from let's say inception to date. Okay, so let's go. If you look at this linkage of subjects, you'll see that SFM is linked to case study, and CSME2 is there, PM is also there. So PM floats to SFM and SFM flows to case study. That is why I've told you from the beginning that this is a multidisciplinary courses. So not without overstressing that, let's move. And recall that I've also told you if you are doing SFM, you should also take cognizance of this weight. You must know everything under the business analysis, assuming you want to do the SFM paper. Okay, I'm just trying to stress it. And the financial decision part too, you must be very, very versatile there. Okay, so let's go for me to walk you through. Even though you are not doing SFM yet, you should be able to flow along with us. So I'm going to go to the investment appraiser part, but that is what we need. Okay, most especially, from the one that there are three decisions, face a manager: investment decisions, financing decision, and dividend decision, right? So that's not an issue. So for appraisal of a project, we have the traditional method of appraising a project, and we have the sophisticated method. So the sophisticated method is what we also look at. For the traditional, the payback period, and ARR, accounting rate of return, is there. And for the sophisticated method, you know that we have the NPV, which you all know, but I'm going to walk us through that part too. So now this is the investment part. So I've summarized this part, the investment part, which I've said we have the traditional and sophisticated method. So here it has to do with the NPV and IRR. Okay, so let's go. This is discounting factor formula. We all know this, but in case study, you don't need all this formula to be written out. You have to look for a shortcut, derive your answer, and move forward. What we needed is the evaluation of the project, and you use it to make decision. Yeah? So there are three things you need when you are doing anything NPV. NPV is net present value, as we all have known. But for you to be in this level, you must have known all these things, okay? But I'm just going to, I'm not assuming that you know, I'm just taking it through, okay? So there are three things majorly you need in MPV. Anytime you see these three things in any section of case study, it means that they are expecting you to prepare MPV. So you don't need anybody to tell you the number of years, the cash flows, which can be inflows and outflows, and the cost of capital. Anytime you have those three things in the case study section of an exhibit, anytime you see that three things, automatically you have to do what? To do your MPV. I hope you take note of that and you know how to compute that. Your number of years is the first thing. Start from year zero. The year zero is the initial capital outlay, where that will be negative, you know. And let me also tell you that it is not only year zero that you have outlay. You can also have year zero negative in year one, year two, depending on the nature of the project, especially building and constructions. Okay. So discounting factor, like I've showed you earlier, what discounting factor the formula is. But for the fast approach or shortcut, you can just, you know, this is 10%. So you can take your calculator and do 1 divided by 1, you know, to give you 1. Then you press divided by. So the denominator of that formula, you see that is 1 plus R. So your R is 10%, which is what? 0.1. So plus 1, you have 1.1. So all the denominator will be 1.1. So here, it means that you're going to divide it by 1.1. So 1 divided by 1 first on your computer, you have press equals to, you have 1. Divided by 1.1, you have what? 0.909. So if you press is equals to again, it will give you for the second year. Press equals to give you for the third year, fourth year, and like that. So you can easily get the discounting factor and move on. Okay. So when you get that, you multiply it by the cash flows, you get the present values. Okay. That means it has been taken into considerations the discounting factor, you know the present value of it. So when you do that, you multiply by the cash flows and get the new present values. So these present values, you add all the inflows minus the outflows before you get your MPV. And MPV can either be positive. When it's positive, you accept. When it's negative, you reject and you make decision. So that means if you are given, this is what you're doing, we're going to do in your appendix, and you also have to make decision like this, just a one line this decision. Okay. So I hope that clarifies. So let's move to the next one. So as we move forward, you know, it's become more complex. Okay. So sometimes you may also be given working capital. So working capital, we have two methods of the working capital. We have the, let's say, I will call it direct, where you have outflows and inflows. What does that mean? Outflows from year zero and inflows in the what? In the last year of the project. So which means it's an additional capital that is introduced into the project and it will be recovered at the expiration of the project. So you should note this. Okay. So anytime you now have cash flows, when a cash flow is consistent for a particular period, and that is what we call annuity. Okay, annuity. So instead of looking for the formula of annuity, what you need to do is that you use that shortcut I have told you. If I'm looking for 1 to 3, year 1 to 3, so the discounting factor for year 1, year 2, year 3, I will add them together. You get the annuity factor for it. The discounting factor for year 1, year 2, year 3, you add them together, you will get this summation. And that is what you're going to use for discounting the total constant cash flows. Okay, you must have a constant cash flows before you can do cumulative discounting factor. Okay, so and when you have a recovery, you have a sales of a machine or a sales of anything that is given, you know, the sales proceed. it will be an inflows in the expiration of the project. Okay, so with that, if you multiply them, you can get your present value. All the inflows minus the outflows to give you your NPV, and the decision will now be positive to accept the project whenever its NPV is positive, and reject whenever it's negative. This is another method, just a layout of preparing it. So anyone you are quoted with, you can use it. So you also take cognizance of cash expenditure, maintenance. You can see all these things, all these words, their outflows is going down, so it must be in negative. Cash received, revenue, sales, their inflows, it must be in positive. Take note of that. So I've talked about, okay, look at what I've talked about this formula. I've told you that if you plus everything together, year 1, year 2, year 3, give you the discounting factor, which is cumulative. And that is what they've proved here. So we moved to the annuity factor. It's still the same thing that I've talked about. Instead of struggling to remember the formula, that calculator that I showed you will be easy. Or you use the rate, but this one they don't give you in case study, so you have to use your calculator. So let's move to the important part. So for the internal rate of return, okay, for the internal rate of return, we all know the internal rate of return is like the equilibrium point, the point where you make no profit or no loss. Okay, so when you have a positive NPV, you are going to make sure you increase it for you to have negative. So if you have a negative, you reduce it for you to have what? Positive NPV. Okay, that's for the cost of capital. Okay, so now instead of you doing trial and error here, you want to, maybe you have positive NPV, the discounting factor is 10%. Instead of doing trial and error 15, 12, just multiply it by 2. You do it immediately, it will give you negative because we don't have time. So this is a typical example of a project, and they say the minimum expected returns is 12% on its investment. So these are their benchmark, and then they are now propose the following. This is the cash outflows and cash inflows for the year 1 to year 4, discounting factor for the year 1 to year 4, and the present values. So this one gives us what? A positive NPV. I want to get a IRR, you have to now increase the discounting factor times 2, like I've told you. So this one, really 15% still gives them negative, but times 2 will throw it to negative immediately. So when you do that and you get the negative NPV, you apply a percentage, which is the discounting factor for the NPV that is positive. Then the NPV that is positive divided by the positive NPV minus, which is plus. Some people just bring plus together. So it depends on what you know how to do best. So you can put it together and then look for the discounting factor between the negative and the positive. At the end of the day, you arrive at a rate. And what is the decision rule? It also has a decision rule for IRR. Okay, when the IRR is greater than the cost of capital, you accept. But in this case, now they gave us a cost of capital, a minimum or a benchmark. So you compare with the benchmark. So now you can see that it's less than the cost of capital. Then the minimum benchmark for the company, so is lesser than, so you reject. Okay, but if it's not, if they are not giving you a standard rate of return for the company, you use it against the first discounting factor. Okay, that is well said. Let's move. We have a lot. I've told you that it's an interpolation. Okay, let's go. Like I've told you, I'm walking through it, what is important. So this might not be important to case study, okay, but let me just tell you what it means. This is a modified internal rate of returns. So there's criticism of the IRR, that the IRR does not take into cognizance the recovery phase. Does not take into cognizance the recovery phase. So they are not divided, the MIR now divided into 2 in terms of the division of the outflows and inflows. The first part, is call it the investment phase, while the income part, which is the inflows part, call it the recovery phase. So, and they did some magic there. Well, it's not magic, but let me first show you. So the case of next time, okay? So now you can see, I've told you when you are investing, when your capital is being inserted or being spent for the proposal or for the project, what happens? It is an outflows. I've told you that outflows can also be year 1, year 2. So in this case now, is in what? Year 0 and year 1. So that is the first phase of the project. You do the MPV for this. Now, the second phase is the phase where you started gaining inflows. You started getting inflows. So that is the second phase. Okay. So the discounting factor for this one, you do it normally, you get your MPV. Now, the discounting factor for this one, you don't do it normally, you do it opposite. What did I mean? You can see here, you want to do 8%. Year 0, everything will be 1. Here will be what? Year 1, which in your discounting factor, you must have used what? Raised to power 1, isn't it? Now, if you want to do it from this recovery phase, you will do it upside down. What did I mean? So you do this discounting factor for year 1. It will take it. Let me take my pen. This discounting factor for this one, year 0, year 1, abi. So here now, the 51, it will be what? Year 0. 70 raised per 0 is 1. So here you now do discounting factor for year 1, discounting factor for year 2, discounting factor for year 3. Okay? You did opposite. That is what I'm trying to say. Okay? Is n divided by the next. That is the formula. So in the case study, I've not seen this, so but I just want to take you through it. So the decision rule, where you have your answer MIRR, the IRR is 11.5, but the MIRR is lower. So it is assumed that the lower reinvestment rate of cash inflows. So that is what that means. So let's move to the other part. Okay. So MPV, is the mother of SFM. Once you know MPV very well, you might, chances of succeeding in SFM is very wide. Okay, once you know it in depth, so there's still taxation to it, there's still inflation to it, to this MPV, and there's still real and nominal cash flows that are resulted to the features equation. So let me treat this sensitivity analysis. Okay, quickly. Now, this sensitivity analysis, they may have taught you so many methods. In SFM, there's no particular way of doing things, okay? What is matters is for you to evaluate it and be able to make decision with it, okay? You can do it any way approach. But I have a seamless approach, for this sensitivity that may be useful to you in any point in time, maybe in SFM or in So what does sensitivity mean? So sensitivity is just trying to test the degree of responsiveness of a particular variable to another. Okay, they want to know how sensitive is profit to revenue, how sensitive is cost to revenue, how sensitive is outlay to revenue. All those things. They want to know how sensitive it is. What does it mean? It aims to tell the manager that your cost must not increase. Cost always increase. In Nigeria, costs don't go down. It's always increase. So the way we are always complaining that the government is not doing well, the last regime, that people were emphasizing that if so person enter, everything will go down, isn't it? But it never went down. So the same way we are complaining about this government, by the next regime, if somebody else comes, we might still have the same problem or worse than that. So, which is based on the reality of inflation over in the global world, not only in Nigeria. Okay, the way people are rushing to poverty in Nigeria, same way I saw an article published in 2024 that people are running away from the UK too, going to the EU countries. You can see, so it's everywhere. So now, so what am I trying to say? So this cost, is usually increases at every point in time. So manager must be very sensitive in this cost. He must be able to know that if costs increase, what is the highest that it will increase to, that will not turn his profit to 0. You can see. Or turn his MPV to negative. Let me use that. So you must be careful. Now, if you calculate this, if costs want to increase per night, it should not increase more than 20%. If it does, your MPV will become what? It become negative. That is what it's saying. So revenue, revenue, what happens to revenue these days? The revenue usually goes down, it doesn't increase beyond a particular or a margin of safety. That is what we call it, margin of safety. So it must not go beyond this part. That is what he's saying. Those are the two things. So you should be cautious and be warning the manager not to allow his revenue or anything income to go down and not to allow anything cost to go up. So that means we are trying to give him a margin of what we call a margin of safety, okay? That you know your equilibrium point. So the margin of safety at which you must not go beyond. That is the notes that I've told you two things. Revenue must not go down, cost must not go up, okay? So you just want to warn the manager against those costs. So what is let me give you a general formula that will help you in every point in time where you have sensitivity in any place. So MPV divided by PV of, in another textbook, it can be anything. They can call it, I have told you, they can call it anything. They can call the formula anything. PV of what? Activities. So activities can be variables, you understand? So it can be cost, it can be anything given the question, okay? So MPV is the profitability itself, okay? You know that, okay? So PV of activities, so times 100. So that is the formula. It works for anything that they want to give to you in sensitivity. So that is all I needed to excel on sensitivity. But let me demonstrate one question for you and we'll move away from that. So like I've told you, I'm walking you through, and you should take note of all these things, okay? Yeah, so it's more bigger now. So now this is a project. They want to know how sensitive is the project to income. You can see how sensitive is the project to income. So that is the question, really. So that means they are saying sensitivity analysis of what? Of income. So remember what I told you. So remember what I told you, that MPV divided by PV of activities. So what is PV of activities? I've showed you the other time, present value when you want to multiply. So which activity are they telling you to do? Income. Income is revenue. Income is sales. I get it, means inflows. Okay. So that means you're going to do PV of what? Income separate. So how would you do that? This is the income for year 1 to year 4. I see now. You now discount it. Discount it with what? Year 1 to year 4 and get the PV. Then sum it together. That is what? The PV of what? Income. Then remember the formula is MPV divided by PV of income. So the MPV is this. They've done it already for you. And if they've not done it in some cases, you should do it yourself. Divided by PV of income. So when you have taken all this PV, all this income times the discounting factor, you now get your what? PV. So sum it together is what you're going to divide it with times 100. Let me see if something was done here like that. So, okay, see it now. See, you can see all the income. You can see the discounting factor. Okay, so, and you get your answer. You now divide it by what? By the MPV. You get 40%. I see now, or 4% rather. So, what is the interpretation? The interpretation is that, this is income, is revenue. It should not drop more than 4%. If it drops more than 4%, the project will become non-accepted. It will be rejected. MPV become negative. Okay, so that is just the interpretation. So the way the question is here, that they are telling you to do income. Okay, they can also tell you to do the running cost. So running cost, which is the negative already, times the word discounting factor, you get your answer total answer in negative, and that is what you use it against the MPV times 100. So for the running cost, it should not increase more than what? That percentage. If it does, MPV will come negative. So there's also another one that I asked you for sensitivity analysis of the capital or capital outlay or cash outflows. Okay, so you also do the same thing. You know, this is year 0, and if you have in year 1, you take it everything, the outlay times the discounting factor for those periods. But in this case now, it's just only in year 0. Anything discounting factor is 1, so you have 55. The 55 divided by the MPV, you get what? You get your sensitivity analysis of what? Of outlay. Now, this sensitivity analysis of outlay will lead me to another question that is called, or another topic that's called profitability index. Okay, which is what? Outlay, initial outlay. Let me use 1O. Initial outlay divided by what? Sorry, I wanted to. So it should now be what? MPV divided by what? PV of what? Of outlay. That is what I meant. So PV of what? Of outlay. Okay, or of outflows. Yeah. So that is what it means. Okay. So that is profitability index. So you might also times 100/1. You might also do the same thing here. Okay, in sensitivity, and it's also represent profitability index. So what do we use profitability index to do in a topic? The topic is called what do we call this topic? Capital rationing. Capital rationing, yes. So capital rationing. So that's will lead us to another topic that is called capital rationing. By the name capital rationing, that means you want to ration capital. So why will you ration capital? That means if they have 2 or more projects that is viable, you want to know which one to invest in. You know, which one are you going to invest in? Okay, let me treat this one before I even move to that one. I'm saying this, so I will not come back there. Probability. Okay, let me summarize what this means. Okay, there are 2 probability in the MPV. Sometimes probability with number of years. Probability with what? Number of years. And probability without number of years. Okay, without number of years. You should be taking cognizance of that. So I will show you what that means. And this one is also called expected value. So summation of the P and X. The P is the probability and X is the outcome of the value of the outcome of each element. Okay, so let's go. Remember, I've told you probability can be in terms of years. What did I mean? Each probability, they say is year 1, year 2, year 3, and the one that did not put number of years. So I want to use to treat that before I move away. Look at this question now. This is the probability with MPV. I see now. Did they give us that this is year 1? They said this one is year 1, this one is year 2, this one is year 3, this one year 4. They did not tell us this is probability without number of years. I see now. So you cannot assume that it's for year 1. You can't assume that this is for year 2. What you are going to do is to do expected value of the MPV. So multiply this one together and get the grand total. That is what it means. So when you get the grand total, it will not be constant for each of the years. Okay, let me show us. So you can see they have multiplied together. They get the expected value of the MPV, which is 92. This 92 now is what you are going to use for year 1, year 2, year 3, year 4, year 5 of the project at hand. I hope you got that. So that is what you are going to do. Please note this. Now, the one that have the number of years, they will have given you that this is year 1, year 2, year 3, year 4, like that. So you will now use all this value in doing your MPV. Whereas the first method is this ground value you will use consistently for year 1 to year 5 as inflows. I hope you got that. Please, can you confirm that you got this?
We are following, sir. So my question would have been, use it from year 1, year 2, the 90 to do what?
I'm not sure I understand your question.
My question is, from what you said, we may not be seeing this as year 1, year 2, year 3. And you say that the 90, that is the EV of 90, is what we now use for year 1, year 2, and continue. So, what are we using it for?
You are using to calculate the MPV. You are using to calculate the MPV. So this should not be your inflows for year 1, year 2, year 3, year 4, year 5. Okay. So, but if you are giving number of years to this probability and this outflows or inflows, so that is what you use directly. Okay. So, thank you. Okay, so that means we can move. Okay, so I've cleared that probability. Remember, I know where I'm going. I'm going to capital rationing. So what is capital rationing variable? So capital rationing is a situation whereby you have a limited capital and you want to invest in 2 or more projects. Okay, so for you to know which project is viable, you can't look at the MPV that is positive, is negative. The one that has positive higher, you will not say yes, it's viable than the other. No, you can't do that. First of all, one of the conditions for capital ration is that all the projects must be viable. All the projects that you want to consider must be viable. That means must be positive. Okay. When they are not positive, how to determine which one are you going to do first or how you want to apportion it? There is what we call divisible and indivisible. What does that mean? Divisible means that the one that you can do part of it. That is, instead of 100% of the project, you can do 70%, 80%. Why the one that if you take A, project A, you must do it 100%. That is indivisible. You cannot divide it. Okay? So now, if you want to not do such, you will use profitability index I gave you as a yardstick. Okay, to determine which one is performing better. Okay. So who can remind me of the formula I gave you for profitability index? The formula for profitability index.
MPV all over present value of activity.
That is sensitivity.
Okay.
Specifically for profitability index.
Okay, is a MPV all over outlay, initial outlay.
So thank you. So is MPV all over PV of the outlay? You have to discount the outlay. So you might be correct if only the outlay is in year 0. But if you do that only when or in a situation where you have outlay in year 0, year 1, year 2, you might lose out. So you must say it completely. Is PV, present value of the outlays. Okay. So thank you. It shows that you're also following. So this is the capital rationing. So let me take that immediately. Remember what I've told you. By the name, it implies that there's not enough capital. There's nowhere in the world that they have enough money. Even though the richest country in the whole world, Luxembourg, does not have everything they needed. Okay, so you must know that. So everybody is rationing the capital that they have. Okay, if everybody has everything that they want in the whole world, then nobody will want to work again. So that is the essence of the capital rationing. You can see. So I've told you they have divisible, we have indivisible, okay? And we have multiple period capital rationing too. Okay, so I've explained all these things. So I've told you now, let's look at the projects now. Project 1, 2, 3, 4. So these projects, remember one of the things I told you, that the project must be viable, it must be positive. Is this one positive? Yes, positive, yes, positive, yes, positive. As to which one are we going to do first? So as an accountant, or you cannot do our financial analyst, you can't just look at MPV and say this one is the highest. I will do this one first. I'll do this one second. I'll do this one third. This one third. I'll do this. No, you can't do that. You have to look at the profitability
index
in terms of the usage of the capital, and that is why we want you to do what? Use profitability index. Okay. So now the profitability index, you have said the formula MPV divided by what? PV of outlay. Okay, so in this case, the outlay here you can see is 5,000 like that. So you have to now compute it, compute it. MPV divided by PV of outlay, you can see. So they will now divide it 62500 divided by 5,000, like that for others too. You have profitability index in this way. You can see if you have used MPV alone, this could have been your first, this could have been your second, this could have been your third, and this could have been your fifth. So that's why I told you can't use that. You have to use what? The capital you have invested to know the percentage of the returns that has been yielded. Okay? So with the profitability index, you have this hierarchy. This is the first one will be 2.0. The second one is 1.3, third one, and fourth one. That means if I want to invest, we'll tell them how much do you have capital that you have in this company. We have 5 million. I want to invest. So the 5 million, you will not see. They say it's divisible or indivisible. They did not tell us. So we assume that it's not divisible. Okay. So now, which one is the first one we're going to invest in? This one. Project 2. This project 2, how much will it take? It will take 2.1 million. So 2.1 million will go out of 5 million. I see now. So it remains, where's my, so out of 5 million, 5.0. So it remains 2.9. So out of the 2.9, which one is the second one that you will invest? This one, which is 1.5 million, 1.5 million, I see. So with that, what will it remain? 1.4. I see that you remain 1.4. So number 3, can you invest in the third one? 5 million. You cannot invest in this one. I see now. What is higher? So what you will do is the balance, all the 1.4 that remains, just use it to invest in here, in the project 1. Everything that remains, okay? Everything that remains, you just push it there. So that is the balance to make it 5 million. So they are in their respective MPV. So you can see that you don't have any choice that to put the remaining balances into here. That is how you will be able to experience efficiency of your capital. The use of your capital in an efficient manner. Okay, so that is for the divisible. Okay, indivisible rather. So I hope that clarifies. So for the one that is okay, this one is the combined. Let me see. So the one that is divisible, okay, they've given a typical example here. You can go out. The one that is divisible, you can do certain percentage in one, can do another percentage in another one. Okay, that is what it means. So, but you can go and read it up so that you can move. I hope I've seen one to just use it to solve it. Okay, but I believe, let me see. So I'm trying to see the divisible one. So okay, so just go and take care of that. Yeah. So that's it. So let's go to another topic. Like I've told you, MPV is the mother of SFM. So let's go to another topic that I call replacement analysis quickly. Replacement analysis, and I'll use the same MPV. Okay, for replacement, you can see the word replacement. If I ask you today, when did you normally replace the globe in your house? Everybody will say, why would I replace it when it has not died? It is until when it dies now. That is where we will go and buy another one. But if you are working in a bank, you can't try that. Can't wait until the globe dies. Because if the globe dies, there's a risk that comes with it. The teller can count cash in essence because there is no light or enough light you can see, and you will now overpay a client, okay, or you should pay a client, and that's its own implication. So with that, managers must be, calculative, and see when will it change all the globes in the banking hub before it actually does what? Before it actually dies. Okay, that is what we call replacement analysis. Okay, so I've told you, summarize it. So now, let me now tell you a formula that you can also use to walk away with replacement analysis. So you can see what they've written here. A lot of, some people might get it confused, you know. So what it means is that just do MPV. I'm giving you a similar one. MPV of the year divided by annuity factor of that year. MPV of what? Of that year divided by the what? Annuity factor of that year. Okay, that is what you need for replacement analysis. It's called equivalent annual cost. Okay, so you can see different formulas, different textbooks will give you formulas. But this is what me have been working with and make it seamless. So I believe I should share it with you. So MPV of the particular year divided by what? The annuity factor of that year. So that is what you will use. So let's go. I don't need to be cramming PV, of course, over one replacement. It's too big for me. So now I know the methodology behind it. I know the strategy behind it. So look at this project now. They said they are considering to replace assets, and they want to replace it in every year, every 2 years or every 3 years. They're not sure. Is it every year they should replace it? Why? They don't want the machine. Maybe they don't use the machine they have in the factory. They don't want it to break down and disappoint their customers and also reduce their income. They don't want it to happen. So they want to know when to replace, even though it's still working. Just like I know of some people that they don't use car more than 1 year. After 1 year, they will sell it and use the money and put more money and buy another one. Why? Because they don't want to be pushing the car, you know, at the Third Mainland Bridge with their pregnancy wife one day. Because everybody that is passing the Third Mainland Bridge, they will be swearing for them. If you don't know how money, why are you buying a car? So you have to make sure that you put your car in a good condition that will, you know, give you set a replacement period for that car. And you will have to do it when it is most costly or optimal. I said less costly rather, or when it's optimal for you to change it. Okay, so that is the philosophy behind it. So we want to advise them that they should change all the machine on every year, every 2 years or every 3 years. So you can see they'll give us maintenance costs. Remember, I've told you anything cost is negative in MPV, and they will discover that I've told you discover is positive. So remember what I've told you, that if I use the car for 1 year, I sell it off. If it's 2 years, I sell it off. If it's 3 years, I sell it off. Okay. So I want to see when it will be optimal for me. So, and the cost of the car is 17,000. So I will do, remember the formula, MPV of the year divided by what? Annuity factor of the year. So for year 1, I will assume the project has expiration of 1 year. So I will do here the purchase cost, year 0, outflows. Okay. So let me do the MPV for year 1. So look at it. The cost of capital will still remain 10%. So year 0, 17,000. So maintenance cost in year 1 is still negative. Okay. Why? If I sell it in year 1, at the end of the year 1, I'll sell it for 8 million. So I will do discounting factor. So the discounting factor for year 1 is and discounting factor for year 0. So you can see that year 1 is be year 1. So I will do the MPV. Some people might call it another name, but I don't care. So it's MPV. You can see it's normal, the way you normally do MPV. Okay. So it will be easier for you. And it will always be negative because you can't make profit because you are spending cost. It's a cost, you are spending money. You want to know where it is less costly for you to spend it. Okay, you can see it's a negative. So let's now use the equivalent annual cost. I told you MPV of that year, which is what? This, divided by what? Annuity factor. Annuity factor for year one, the same thing as discounting factor for year one. You can go and do it with the formula. So you now have what? 0.901. So you get what? 12,602. So this 12,602 is the negative. Okay? Is the negative. Remember the MPV you used was negative. So that is the first one. The second one is that I'm going to also assume that I'm going to use the machine for 3 years. So I'm not going to sell it in year one. So I will sell it in year two and also do the MPV. So year one, I spent 17 million to buy it. Year zero, 70 million. Year one, the cost I used to maintain the car is 1.9 million. Year two, I spent 2.4 million. Okay. Year two, at the end of the year two, I sold it out. So it is in positive. I see now. So discount value. So now I will now use discounting factor for year zero, year one, year two. Okay, I'll get my MPV. So this MPV now divided by annuity factor for year two. So remember, I've told you how to do it for annuity factor. Don't start doing the formula, because if you do mistake of minus in the formula, you are in soup. The whole things will scatter. So for you to do that, just add these two elements together. Annuity factor for year one, discounting factor rather for year one, and discounting factor for year two. It's give you to what? The annuity factor for year two. I see now. And you divide it with it, you get your answer, which is annual cost. Okay. So I have this one. I have this one. So I will now do the same thing for year three. I will assume that the machine we use 3 years. I see now. Purchase years, maintenance cost 1, cost 2, cost 3, and sell it in year 4 and year 3. I will sell it in year 3. Okay. So they did mistake here. They're supposed to write 3. So year 3. Okay. So you can see the discounting factor was for year 3. So it's good to know what is right. So you now do the MPV. When you do your MPV, you now divide it by the annuity factor. So for you to know annuity factor for year 3, you add these 3 together. You get the annuity factor. So when you divide it, you have your answer. So now, which of the years, which one is less costly? So you do a summary. Year 2, year 1, year 2, year 3. So now, so which one has the lowest in this table? So the one that has the lowest is year 3. That means it is less costly for them to replace the assets in year 3. Do we understand this? Any question? So, any question? I hope it's well clear. I need some feedback. I hope you are with me.
We are with you, sir.
So that's how to do it. So that's how it goes on and on to other areas. So I think that's fine for SFM. The other part is about inflation. The other part is also about taxation and also your Fisher's equation, where you have the real and cost of capital and nominal cost of capital. So you use likes for likes. Okay, we've done this in our SFM before. So we have another one. Let's go to PM. So I will now overflow this part. Another part, another topic that is also interesting here is evaluation of business, acquisition and merger. Okay, so you can go through that at a convenient time too as well. Okay. So for PM, so there are basically things I will just show you. Okay, you don't need in-depth knowledge, too much knowledge. That's why I don't do those very fair for you. And I've gone so deep for SFM. You can see the business valuation I told you about is still here. The sensitivity is still here, and like that. So you can read the SFM, the case study pack. You see the capital reorganization and everything there. So, So let me walk us through. But let me use let me use a whiteboard to explain, because it's not like something that we use to explain that will be easier for you. Okay, so that is what I'm looking at. Okay, can you confirm if you can see my whiteboard?
Yes, you can see the whiteboard.
So, like I've told you, we just need a prerequisite knowledge. We don't need to cram anything in those areas. Just a peripheral part that we will leverage upon to make decisions. Okay. So for PM, one of the basic parts is, let's say, for variance analysis. Okay. Variance analysis. So for variance, you are going to measure between the budget and the actual. Okay. Sometimes they may not tell you directly in the question that is variance. You have to deduce it yourself. That when you have budget, if you're talking about budget is not meaningful except you compare it with what actual. And there are two dynamics to it. We have the one for income, or let me say revenue, and we have the one for cost. The way you treat income and cost are different. Okay. So for example, for revenue, we budgeted 20 million for year 2024, and we now made 15 million. Okay, we now made what? 15 million. So do we gain or do we make loss? Class, is it favorable or adverse?
Favorable.
Okay, another person?
That's
So you can see
adverse
what.
for
Okay,
revenue.
you can see some people are saying favorable, some people are saying adverse. I understand, but let me
Adverse.
explain. That's why it is not. You may not look at it as 20 minus 15 is 5. So that's 5 is positive. Now say it's favorable. No, don't do that. So you look at the element that is concerned. That is why I don't want to take you to textbook. I don't want to. This case study is not an academic exam. What did I mean? That will tell you A plus A is B, and you have to be writing A plus A is B. No, 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 no. You have to look at the scenario at hand to be able to justify if this A plus A should be B. Okay? Just like you say, 2 plus 2 is 5 for synergy. You understand? If you look at it, you say, no, it's 4. But if you look at if you look at it from an academic point of view, you say it's 4. But if you look at it from the logical point of view, or strategic point of view, you say it's 5. Okay? So that is what I want to show you today. That is why I don't want to go to books for that, or textbooks. So now you can see this revenue. I want to make 20 million in this year. I eventually made 15 million. I have not achieved what I have budgeted. So that means I have what? Adverse. 5 million adverse. But if I budget to spend 20 million and I eventually spend 15 million, what has happened? 5, right? But is it positive or negative? So you don't need to use that. You need to say, okay, I said I will spend 20 million, I spend 15 million. That means I've saved. So this one is what? Favorable. Do you see? So it is the subject at hand that you use to determine if it's favorable or adverse. And this is the prerequisite knowledge I need you to do to understand. If you understand this, you will now castigate this down to the financial statement. From revenue, cost of sales, I see in gross profit down to net profit. They may now ask you to, compare the budgeted to the actual. So remember these two things I've told you. You look at the item, revenue, you treat it the way I've treated item and get your variance. You look at the cost of sales is going out, so it's cost. So you must spend lower cost. If you spend lower cost, you have saved. If you spend higher cost or the same cost, you are in advance. I see now, down to all the items. So expense also cost. I get me now. That is how to now do it for all the items that you might encounter in the course of your evaluation. Please, do you understand this part, class?
It's flowing.
Thank you. So if it is clear, we can move to the next one. Let's create one more page. Okay, let me clear it. So I want to apologize. When we did the financial analysis, those things I wrote on the board, fortunately, I did not save them. You know, and that is one of the essence that you need to come into class and be jotting it. But if you go through the videos, you will see them, and you can write them down. Okay, but I promise that I'm going to share what I've written on the board, but unfortunately, I did not save that. So I apologize for that once again. So let's go. So, but this one I just did. I don't think it's necessary for me to be sharing this. It's just small abuse. So let's go to the next one. So the next one is contribution margin ratios. So, what's a contribution margin ratios? Okay. What did I need? As simple as it is. Now say it's fixed cost. Let me start from the beginning. So if you say the break even, fixed cost divided by contribution margin ratio. So for contribution margin ratio, it should not be what? Contribution divided by what? Sales. For contribution, don't mind my Zoom pen, now be what? Sales minus what? Variable cost. Do you get? So you can see these are the prerequisites that we have known that we needed. For SFM, for case study rather, if you want to do this, this is what you know. This is what is the basis. But for you to get fixed cost, it's not only you just go and pick fixed cost and come and put it in. They may give you year 1, year 2, year 3, year 4, year 5, year 6, and give you different items, head office cost, power, lights. Are you getting me now? What else? All the fixed costs they will give you. So you have to take them one after the other, sum everything together to a total. Are you getting me? And get the grand total. So the grand total that you are going to get after summing everything for all the years is what will now come into your fixed cost. Do you see? So ability to be able to go and source for it. This can be scattered haphazardly, in the exhibit. So you have to source for all the fixed variables, fixed elements rather. So for variable 2, the same thing. You have to go and source for all the variables. Do the cumulative for the year to make this variable. Sales still the same thing. Okay, the sales. For example, maybe they have product A, product B, product C, product D. So you have the total. So for you to get it, you will see price times quantity. Okay, so you have to do the summation of every product before you can get the grand total. It's the grand total that will come here. I hope you've seen how it is. So you must understand the basis. So this part, it may be scattered. You have to go and align them together and get it before you can get contribution. Before you can make contribution to be contribution margin ratio. Before you can adopt it and get what? And get your break-even point, the point at which you make no profit or no loss. Do we understand this part? Any question? So that means like most one now is let's say balance scorecard. Balance scorecard. So the balance scorecard now is a tools, is a performance management tool that is used for both financial and non-financial analysis. Non-financial. Okay. So the financial part, you see the ratios, blah, blah, blah there. For the non-financial part, they must give you what we call the KPI or give you critical success factors. Okay, so but the non-financial part, what you needed there is quantitative reasons. Quantitative reasons, just like the quantitative reasons they normally do in secondary, primary school, juniors.
Hello, sir, please. Hello, sir. Please, I'm interested in this balance forecast. I've always had this even during my PMD. To get it clear. You said it's a financial management tool that is used for both financial and non-financial work. I want to get
primary school, yes, primary school they used to do it. I see patients days they are calculate. So there is no particular one way to this. You have to use logic, reasonings. So you can look at it. There are some people in this exam when balance scorecard came. So people who submitted and go and give up. I say, I PM, you came to meet me here again. So people started sleeping. No. You don't do that. If you did not know things, use your normal, what will I say, layman view to it. So now this thing that made people fail in that diet and they ran away because of balance scorecard was simple. Was just filling the gaps. When I later did the analysis for them. Look at this one now. One of the points is paid patient days. So how many days does hospital opens class in a year?
Hospitals every day.
365 days. So that means 365 days every day in the year, right? So, and if it's a leap year, 366. So you must be careful with that. Now, you have to now say patients, Abi, how many patients came to the hospital for that year? You source for the information in your SBT. Maybe they are telling you that 25 patients has come. They may not be certain, they may say averagely. I see now 25 patients, 25,000 patients. So how much will each person pay averagely? Averagely. I see now. That too, they must have given you, or you can even compute it by giving you high value and the lowest value that they pay in their hospital. High and low method. You get the highest and get the lowest. They will give you that one. So you just do the average to know average amount they paid. Let's say averagely they pay 1.5. So with that, I'm good to go. I will know the answer. There you see, paid patient days. So it's logic you will use. It's reasonings you will use. So not the one you have read somewhere. No. And that is the beauty of the case study. You use intuition, you use reasons, you give practicable recommendations. You don't do la cam la po. You don't say you have read that balance scorecard is defined as Akombi and start saying balance scorecard is defined as no, mark will not be given. I hope that clarifies. So I think I've done justice to it. That's all for what I would say for PM. Any other thing? Okay, profit analysis. Profit analysis, another one that we've seen. Profit analysis just sales minus cost of profits. That's just it. That is the prerequisite. So for you to not get sales, you can add so many items together. Cost can have so many items together. You know, the cost that has to do with material, labor, indirect costs, direct costs. I get me now. All those costs before you now get profit. That's another profit analysis. Okay? So I think that's all. Thank you. Any question?
We are with you, sir.
Any question from any other person before we close out for today? So in the absence of no, thank you very much. Have a wonderful bed rest and ensure that you do your assignment. I've not seen some people's assignment. And if you send me an assignment, I've not done it, I've not marked it, try to send me a reminder. Thank you. See you next week. We'll be talking about report writing.
Hello,
Excuses.
hello, sir.
Yes.
Hello, sir. Sir, please. It's on the assignment. That camel for the assignment, that bank stuff. That's why I've not passed mine. I don't know how to go about it.
I think I shared it. Let me see. Give assignment on camera. I just say you should go and read that or digest it. I shared it on the Telegram. So I will point to it now on the Telegram. So you can go and take it. But the assignment I gave is on the breaking down of requirement question. I've pointed to it now.
No, after the breaking down of requirement stuff, you have given another assignment on March, July, and November 2019 on the trend and ratio.
Okay, that's financial. So for the financial, I told us to okay, the financial, the question I think I gave was that you guys should go and calculate the November 2019 alone.
Yeah.
November 2019. Go and do the trend that I have done, the ratios, the common size. Go and do it, go and particularize it. Please, all these things I'm giving you is planned though. I think I told you earlier in the first class that all my statements, they are deliberate, they are planned, they are intentional. Because I will still need all this calculation I say you should go and do. I will need this when you get to report writing. So I will not allow people to draw me back by saying, I don't know where you get that figure from. Because I will be using the same assignment I've given you. I will be using those figures to analyze the report. I hope you got that.
Yes, sir.
So thank you very much. Please endeavor to do your assignment and be up to speed what we're doing. So we have a lot. Thank you. Good night, everyone.
Good night, sir.
Thank you, sir. Good night, sir.